The difference between stocks and bonds. Let's talk about the difference between stocks and bonds, two of the most common ways to invest your money. When you buy a stock, you're buying a small ownership stake in a company. If the company does well, its stock price goes up, and your investment can grow. But stocks can also be risky, because if the company performs poorly, the value of your shares can drop. On the other hand, when you buy a bond, you're essentially lending money to a company or government. In return, they promise to pay you back with interest over time. Bonds are generally seen as safer because you're guaranteed some return unless the borrower defaults, but the potential profits are usually smaller compared to stocks. So, to sum it up, stocks are about owning a piece of the company, which can be risky but rewarding, while bonds are more like a loan that provides steady income but with less risk. Your choice depends on how much risk you're willing to take for potential returns.
Now let's talk about why stock prices go up and down. It might seem random at first, but there's a lot going on behind the scenes. First off, stock prices are all about supply and demand. When more people want to buy a stock, its price goes up. When more people are selling it, the price drops. But what actually causes people to buy or sell? A lot of it comes down to how a company is doing. If a company reports great earnings or announces an exciting new product, more investors want to buy in, pushing the price higher.
On the flip side, bad news like missing earnings targets or negative press can make investors nervous and lead to selling, which drops the price. Then there's market sentiment. This is influenced by things like economic news, changes in interest rates, or even global events. Good news about the economy can lift stock prices, while uncertainty or negative news can cause panic selling. And finally, there's investor psychology. Believe it or not, emotions play a big role. If a stock is doing well, more people tend to buy it, thinking the price will keep going up. But when stocks start falling, fear kicks in, and many rush to sell, causing the price to drop even more. So, in a nutshell, stock prices are constantly moving because of a mix of company performance, economic factors, and human behavior. It's a complex system, but understanding the basics can help you navigate the ups and downs of the market.